Bloomberg News on demand. Bloomberg Surveillance with Ken Pruitt and Tom Keene. Tuesday, July 7th, 2009.
Joining us from northern Thailand, from Chiang Mai, Marc Faber. Lots to dive into here in the Gloom, Boom, and Doom report, and many of our listeners know your work. I want to go right away to the weak dollar. Is now the time? How do you time a Faber call on a dollar that's going to give way to weakness?
Well, first of all, I'd like to point out that in the last 2 weeks, I've made a call that basically U.S. government bonds could recover somewhat, that the U.S. dollar could recover somewhat, and that asset markets like commodities and equities would enter a correction period. But that is a short-term call. Longer term, I'm fairly sure that the U.S. dollar direction will be down. Now we will have to define down against what, because it is conceivable that the U.S. prints money and that other central bankers print even more money, and then the dollar is, say, strong against a very weak currency like the Zimbabwe dollar, but weak against a hard currency like gold, silver, platinum, and palladium.
Isn't there the ability of second-order effects to come in, and that we get nominal or real GDP back to not a great level, but a good enough level to promote some form of stability, looking out 2 years, 3 years, 5 years?
Well, I mean, the economy globally fell off a cliff between September 2008 and March of this year, and there hasn't been much of an improvement since then. The rate of worsening has diminished. In other words, the economy is just flat on its back. There's not much of an improvement, but it's not getting much worse from here. And eventually there'll be some kind of a recovery, yes, but the question is when, how long it will take, and what this recovery will look like in terms of inflation.
Well, Mark, it seems the markets have been reacting here since last Thursday when we got the jobs report for the month of June. More people than anticipated had lost their jobs. Is that the darkest spot that you see on the economy?
Not necessarily. There will be another few shocks like commercial real estate and also capital spending that will be weak, because now a lot of capital goods manufacturers, such as, say, aircraft manufacturers such as Airbus and Boeing, they're still filling out orders which they received 2-3 years ago. But the new orders are very rare at the present time. So that will then come about, the decline in that activity, namely capital spending, will come especially next year. But I'd like to point out, I mean, we have a government stimulus package that will increase the fiscal deficit this year to, say, $2 trillion. Officially, it's $1.8 trillion. But I would guess that at the end of 2009, the deficit will have been in the order of $2 trillion. And at the same time, we have very expansionary monetary policies where the Fed essentially monetizes the Treasury's debt. And what it can do is it can lift the economy temporarily. In other words, you could have a rebound from here. Now comes 2010. If the fiscal deficit in 2010 remains at the same level and monetary policies are equally easy as today, the stimulus will be gone. The only way to have another stimulus would be to then increase the fiscal deficit. And as you've read the press and as you have maybe heard from different academics, it is likely that the further stimulus package will come about and further easing will come about. And in my opinion, in the long run, this will be inflationary. And when you have a country that inflates, then obviously its currency begins to depreciate.
Our guest is Marc Faber of the Gloom, Boom, and Doom report. And, Mark, the latest on that, on government spending comes from Laura Tyson, advisor to the president, who stressed that she was speaking only for herself. She was in Singapore, but she said there should be another stimulus package, and this goes along with calls by, New York Times columnist and Nobel Prize winner Paul Krugman and others, and you're saying that would be a bad idea.
I think it would be a horrible idea, a terrible idea. But some people believe in the Keynesian theories that if you have an economy, then the government is in a position to steer this economy through ups and downs by creating deficits and with easy monetary policies. In theory, in textbooks, it would work if you had an economic expansion, and during the economic expansion you create large fiscal surpluses. In other words, you tax relatively heavily and you put reserves aside and you keep money tight. And when the economy slows down, it wouldn't collapse because there wasn't, under these conditions of increasing taxation during an economic expansion, it never comes to a boom and under tight monetary conditions.
Is a distinction here, Dr. Faber, and I guess it goes back to Zurich and your PhD there and on to Whitewell and Drexel Burnham. I mean, the idea here is the relative response of other nations. Is the linchpin here to your caution the response of other nations, or is it the response of the United States?
Well, basically, I'm discouraged by all governments in the world who believe that when you have had a boom, and the boom was artificially induced, in the case of the U.S., by ultra-expansionary monetary policies actually starting with the bailout of LTCM in 1998, but in particular after 2001, when the Fed fund rate was slashed down to 1% and kept at 1% until 2004, when actually the economy began to recover in November 2001. So almost 3 years into an economic expansion, you had 1% Fed fund rate, and that created a bubble in the housing market.
Mark, you list one of the great books of all time here in your analysis of inflation. It's Samuelson, Coleman, and Skidmore. This is a few years ago, folks. Readings in Economics, 1952. Marc Faber, why do we have to go back to 1952 to figure out inflation?
Well, I go back 200 years or 300 years to figure out inflation. There has always been in every society periods of inflation. The first well-documented one was obviously in the Roman Empire, but previous societies also had it, because it's simply very easy for governments to increase the quantity of money, and then sooner or later you get inflation, and you can hide a lot of problems, and you can shift wealth from ordinary people that work hard, the working class, and the middle class, and the academics who are teachers and professors and so forth. You can shift that wealth to the speculators.
Then, Mark, how do you explain the great disinflation? If we go back to Volcker's 79 and we look at 15 or 20 years of trend here of moderation, lack of volatility, how do you explain then the success